Good morning, everyone. Welcome to the Recover California Homebuyer Assistance Program Lender Training. My name is Megan Harris. I'll be hosting the training this morning. And I want to thank everyone for taking time out of your day to learn about this program. Before we dive in, I do want to cover a couple of housekeeping items. First and foremost, this is an interactive training. However, your mics are muted and your chat function is disabled. So if you have any questions or feedback you'd like to communicate, be sure to use the Q&A icon on your webinar toolbar. If you click on that, it'll open up a dialog box, and that's where you'll be able to type in your question or feedback, and I'll see it there. And we will have a Q&A session at the end of our call today. And so I will get to all the questions at the end. Be sure to pay close attention as we're moving through the content so you don't miss any important information. Oftentimes, people's questions are answered as we're moving along, just as an organic progression of the content. So keep that in mind as well. And then if you need credit for the course so you can access the program, you want to make sure you stay until we get to the end and the Q&A session, so that way the platform captures your attendance and you'll receive credit for the course. I will be sending out a copy of the slides from today's presentation for everyone who is in attendance at the end, right? So once we get to the Q&A, if your attendance is captured, you'll be sent a copy of the slides within 1 to 2 business days. And the slides are sent as a PDF attachment to the email address that you registered for training with. So keep that in mind. Keep an eye out for that email. The slides will not only be proof of your attendance, but it'll also function as sort of a job aid that you'll be able to refer back to for concepts and topics that I don't expect everyone to memorize. There is a lot of information here. So again, the slides will be helpful in helping you navigate the program going forward. So with that said, I think that covers all the housekeeping items. Once again, welcome to the Recover California Homebuyer Assistance Program Lender Training. Let's go ahead and get started. So if you're new to GSFA, we are a housing finance agency, and our business is to support affordable home ownership opportunities for Californians. And this is something we've been doing for over 30 years here, providing down payment and closing cost assistance. We essentially just take ordinary mortgage loans and enhance them with our programs to improve home buyers' purchasing power in these transactions. And so far, we've provided over $680 million in down payment assistance to over 86,800 home buyers. But the Recover California home buyer assistance program rather is a lot different than other down payment assistance programs that we've offered in the past. This program is specifically targeted to assist low to moderate income households that were impacted by wildfires here in California in 2017 and 2018. The assistance provides up to $350,000 per household to help them purchase a home outside of a high or very high risk area for wildfire. So today we're going to cover the program itself and all the ins and outs. This program is special because it was provided by the California Department of Housing and Community Development, and it's funded through a community development block grant for disaster recovery from HUD. Okay, so that's a big part of the reason why it's different from a lot of our other programs. And essentially, HCD, which is the Department of Housing and Community Development, sought out GSFA to administer this program due to our legacy of providing down payment assistance programs for over 30 years here in California. And so our mission is to make sure that this program gets in contact with its target recipients. Okay. So we're going to talk about the program advantages and benefits today, as well as the eligibility requirements. We're also going to talk about the structure in terms of the assistance. It's called HBA, which stands for Home Buyer Assistance. It's an interchangeable term for down payment assistance. And so you'll hear the assistance used or termed as HBA accordingly. Just remember that's the same thing as DPA, right, for down payment assistance. We're going to talk about the first mortgage guidelines as well as the application and loan process, as well as next steps after you complete the training today. So I want to draw your attention to our lender participation guide because this is going to be the hub for all the resources and content that you'll need as you're navigating the Recover California HBA program. Now, this particular allocation is for fire folks, right? Folks who were impacted by wildfires in California. We do have a separate allocation for flood, which you will see content for on the lender participation guide as well. But since we're here learning about the fire program today, I want to make sure you're clear that you are distinguishing the fire allocation from the flood allocation when you visit our lender participation guide. So in the lender participation guide, we're going to have the term sheets, right? The term sheets are going to spell out all of the requirements that are posted on GSFA's website for the program, and it also includes HCD's eligibility requirements. And so it's a comprehensive guide that's going to break down everything for you, let you know what's required, who's eligible, the structure of the assistance, etc. And as I mentioned, this program is entirely different from any other GSFA program. So you really want to make sure you're dialed in on this lender participation guide and you know exactly where to find it. So let's get into applicant eligibility. As I mentioned before, this program is targeted towards low to moderate income households who are renters or homeowners, and their primary residence was in a high or very high risk area for wildfire, also known as a fire hazard severity zone. And there's going to be a specific way that you determine that. We actually have a link on our website as well as in your slides here that takes you to the tool that helps you determine whether their home was in a high risk area or not. So let's actually visit that tool now. I'm clicking on the link and it's bringing us to the website. So what we want to do is click on I understand. Okay, and this is CAL FIRE Fire Hazard Severity Zone Viewer. It brings up a map of California, and you're able to look up an address and determine what the risk for wildfire was at that particular location. And there's a key here to the right that gives you colors, right, to tell you what those colors mean in terms of the high fire, low fire, moderate, etc., risk for a specific area. Okay, so we've got this. This is, believe it or not, this is actually kind of a pink color, but because the backdrop is charcoal, it's kind of coming across as more of a mauve. Okay, but pink is very high. Then we've got orange underneath that, which is high. Okay, and then we've got yellow, which is moderate. Then in the second section here, red is very high, orange is high, and then yellow is moderate. And then we've got these neutral colors here down at the bottom. So what we're looking for right now is to determine if our client lived in a high-risk area for wildfire at the time of the disaster, okay? And so what we want to do is click on this little magnifying glass here and type in an address. So I'm going to type in an address. All right. So my address is pulling up in this pink color, okay? And so that means it was very high. So this is what we want to see when we're qualifying an applicant for this program to determine their initial eligibility, right? So we want to see the colors pink, orange, or red when we are looking up a subject or a impact property rather. Okay, so just keep that in mind. They do not have to be a first-time home buyer. Okay, so even if they've owned a home in the past, they can still qualify for this program as long as they don't own any real estate at the time of their application through close of escrow. They also cannot be in contract at the time of application, right? So you want to make sure your borrower is not in contract. They're not even really shopping for a home when you initially apply on their behalf for this program, and we'll get more into the details on that later. So here are the eligible areas. Your client needs to have lived in one of these areas corresponding to a specific disaster year. Okay, so for 2017, they needed to have lived in Sonoma County, Ventura County, and then zip codes 95470, 95901, 954 or 94558, 95422, and 93108. And we can see here on the sides where these zip codes are located. Okay, so be mindful of that. And then for 2018, it's actually whole counties, right? So 2018 is going to give you Butte, Lake, Los Angeles, and Shasta as your eligible counties. The applicant does not have to live there now, but they do need to have lived there in one of these corresponding disaster years. And again, specific to these locations, depending on the disaster year. So as I mentioned, income, right? Low to moderate income households are targeted by this program. And it's a very core component to your client's eligibility. So the income limits are going to be based on household income, right? So not just the borrowers, but the whole entire income for the household. So that means above and beyond whatever the income you're using to qualify on that loan application is, okay? Also dictated by the household size, right? So how many people will live in the home? And then we have the county where the subject property is being located. So I want to circle back to this household income piece really quick here. So household income captures all adults 18 and over who receive an income that's expected to continue for at least the next year. Okay, so it doesn't matter if they're going on your mortgage loan application or not. If they live in the home, they're 18 and over, they get an income, it's going to continue for a year. You need to factor that into your household income calculation. So you're essentially going to have two calculations, right? You're going to have your income calculation for the household as well as your qualifying income calculation for your 1003 loan application. Okay, and so those figures might be different based on who's going in to the loan versus who will live in the property, right? Also versus income you might be excluding as a lender, right? Maybe the income has been coming in, but there's not a sufficient history of it enough for you to include it in your qualifying income, right? So you're excluding it on your 1003, but you're not going to exclude it on the household income. Okay, you want to make sure that's all in there. So let's actually take a look at the income limits. So we have an idea of what those look like. This is a link to the HUD website that gives us the income limit. And again, the money is coming from HUD to fund this program. So we are abiding by HUD's income limits for the program as well. Now, if anyone has a county they would like me to look up specifically, you're welcome to type that into the Q&A box and I'll look that up. But for right now, I'm going to go ahead and choose one here. Let's go with Los Angeles County. Okay, that's one of our eligible counties. And again, they don't even have to purchase in the county where the disaster was. Of course, they are welcome to, and most people actually do because that's home for them, right? And so they want to just reestablish home in an area that they've already had community with, right? So we're going to go ahead and look at Los Angeles County limits for now. Okay, so this is what the income limits page looks like. And this link is also available on our website in the lender participation guide for the program. So you want to make sure you are dialed in and familiar with that location. Okay, so if we start here at the top at persons and family, right? This is the number of people who will live in the home, and that's going to dictate the overall income limit. we're going to focus on this low 80% income limit here. That is the income limit that we use for this program. And so for a one-person household in Los Angeles County, the income limit is $84,850. Now, let's say we have a household with one adult and three children, right, in Los Angeles County. And again, this is where they're purchasing the home, right? Not necessarily where they live now, but where they're going to be purchasing. That's the county we want to look up. So they're going to buy a home in Los Angeles County, and there's three people that'll live there, one adult, three kids. We've got an income limit of 109,050. And I want to make sure everyone's clear that you need to use these income limits because the other income limits we have posted on our website in other sections do not apply to Recover California. Okay, so you want to make sure you're dialed in on the income limits specific to this program. So homebuyer education is another key component of your applicant, your borrower, your client's successful completion of the program. And so at least one borrower needs to complete homebuyer education. It's a specific online 8-hour course that is available through eHome America. And the course has a discounted rate negotiated by GSFA, which can also be reimbursed through the assistance from the program. You just want to make sure you have that clearly identified as a POC on your CD. Now, eHome America does offer other courses for other agencies. So you can't just randomly go to eHome America and have your borrower take a course. You want to make sure it's specific to our program. And the link for this course is also on our website. Okay, so your client needs to see these logos at the top of their screen when they get started on their home buyer education. Okay, if you don't see these logos, it's not the correct course, and that is extremely important. Okay, there are other agencies that are offering courses through eHome America, but there's only one for Recover California. Okay. So what we're looking at now is a general overview. I mean, a super high level overview of the program. It's actually way more involved in detail than that, but this is just an illustration to give you a general gist of how this is going to go. Okay, so you're going to first determine your borrower's eligibility. You're then going to figure out how much of a first mortgage loan that can they afford, right? Regardless of assistance, what can they afford on a first mortgage loan payment? And then you're going to take that first mortgage loan amount and estimate the assistance they can get from the program based on home prices in their market, right? So you're going to be able to get a general estimate of what the assistance would be for them based on your first mortgage and the home price. Okay. And again, the assistance goes up to $350,000. Then they're going to search for a home. Then you're going to officially lock in your rate for the first mortgage with us, as well as officially reserve the assistance. Okay. And then your borrower is going to complete their home buyer education course, and then we close escrow. Okay. Sounds great, right? Nice and smooth. But again, there are a lot of details. So let's get into the structure and terms of the assistance. So as I mentioned, the assistance is available up to $350,000, and not everyone's going to get the full $350,000 because it is based on applicant need, right? So how much do they actually need? If you do the math and your borrower doesn't actually need assistance from the program, they won't get any, okay? Other factors that go into it are the duplication of benefits, and we'll talk more on that in a minute. If they have liquid assets over 100K, the portion over 100K may need to be contributed to the transaction. And then, of course, as long as funding is available, they can have access to the assistance. But when the allocation is exhausted, then, of course, there's no assistance to be had. Okay. So when it comes to the structure of the assistance, it's provided as a forgivable second mortgage. The second mortgage has a 0% interest rate and it's deferred, so there are no monthly payments. It has a 5-year owner occupancy restrictive covenant, which means that the borrower needs to live there in order for the forgiveness to kick in. Okay. And every year, the borrower resides in the property as a primary residence, 20% of the balance on that second is forgiven. So by the time they get to year 5, the entire balance has been forgiven and it frees up the amount of assistance they received up to $350,000 in equity, not to mention all the equity they've accumulated over the course of that 5 years. Now, I do want to mention in the event of a default on occupancy, right? Say your borrower decides to move out after 3 years. They have 2 years remaining on that term, and that would be the portion they would have to repay, right? So any unforgiven portion would have to be repaid in the event of a default on occupancy. Also, in the event there's any kind of misrepresentation or fraud detected post-closing, the entire balance that was provided to the borrower as assistance would be recalled. Okay. And depending on the scope of the fraud and whose responsibility it is, it may be a situation where the lender has to repurchase the loan or where the buyer has to pay it back. Okay. It just depends. Now, fortunately, we haven't had that happen yet, and I hope that we don't. It's unlikely, but again, we just want to make sure there's full transparency here. Now, in terms of what the assistance can be used for, so it's essentially designed to close the gap between the first mortgage loan and the purchase price. Okay, so down payment, also closing costs, including prepaids, POCs, right? Your appraisal, credit report, all those fees, right? You do have to make sure that all of those fees are clearly disclosed, especially if you have any POCs, right? You want to make sure they're clearly disclosed on your CD and settlement statement. If rates improve and your buyer decides they want to go ahead and refi, right, before their full 5 years is up, if they refi through US Bank or through a correspondent lender of US Bank, where US Bank ends up being the servicer, or use our GSFA Platinum program to refinance, that second will resubordinate. So when it comes to first mortgage guidelines, so this program is obviously for purchase transactions only. GSFA sets the interest rate for the first mortgage loan, and they're all 30-year fixed rate first mortgages. Okay. The loan types we have available are FHA, VA, USDA, and HUD 184 loans for government. HUD 184 loans are available to buyers who want to purchase a home on tribal land. And then for conventional loans, we have Freddie Mac HFA Advantage available. The loan limit follows the national conforming loan limit of $832,750, or the loan limit for the county and loan type, whichever is lower. You can add upfront MIP or VA funding fee to that limit as well as applicable. Okay. Minimum credit score is only 640, so perfect credit is not required. However, if it's a manufactured home or a HUD 184 loan, the minimum credit score would be 660. Now, one of the unique things about this program is that it has not only a maximum debt to income ratio, but a minimum debt to income ratio. And a lot of people get hung up here because they're not used to that. So they see this 42 and they think, oh, that's the front end ratio. No, the front end ratio is the HTI, right? The housing to income ratio. The DTI is the debt to income ratio. So that's all of the borrower's debts, including the PITIA, right? That number cannot be lower than 42%. Okay. And then, of course, we want to make sure that the borrower can actually afford the payment long term. So there is going to be a max debt to income ratio of 45%. And I just want to emphasize here, both of these figures correlate to the back end ratio. There is no minimum front end ratio. There is no maximum front end ratio unless you're using a HUD 184 loan, in which they have different ratio requirements altogether. But for everybody else, you just want to make sure that DTI is somewhere between 42 and 45. We try to recommend folks qualifying their borrower somewhere in the middle, 43-ish, right? 43 and a half. That way, as figures shift and fluctuate over the course of the transaction, it won't or is less likely to materially impact the borrower's eligibility. You also want to make sure you have an AUS approval, right? So regardless of whatever origination system you're using, make sure it is AUS approved. So when it comes to eligible property, so this is the property that the borrower will purchase through the program. It has to be an owner-occupied home classified as a single-family, one-unit property. It's okay if there's an ADU on the property, that's perfectly fine. We also allow condos, townhomes, and PUDs, manufactured homes. Keep in mind there is that FICO overlay for manufactured home, as well as a max loan to value of 95% on manufactured home when it's through Freddie Mac. The properties we cannot finance through the program are tenant occupied properties. So that means the property either needs to be vacant or owner occupied when your borrower gets into contract. The only exception to the property being tenant occupied is if the borrower is the tenant, right, purchasing the home from their landlord. Otherwise, that tenant needs to be vacated prior to the contract date. We also don't allow 2 to 4 units, co-ops, investment, second, and vacation homes. So keep that in mind as well. And of course, the new property must be located outside of a high-risk area for wildfire, okay? And there's a separate tool. It's the same CAL FIRE mechanism, right? But there's a different version of this tool that we're going to use to check the subject property. Again, the property being purchased through the program. So we can click on that link to get there now. Okay, and as we can see, it looks a little bit different. There's some outlines here, different phases. So this is the map you'll be checking the subject property against. We still have our color key here to the right that's going to let us know what colors represent when we pull up the address. Okay, now this is the time we don't want to see our property in a very high or high fire hazard severity zone, right? When we're qualifying them for the program, we want to see it. But when we're looking at the subject property, we don't want to see it. We want to see a neutral color, okay? Or at the very least moderate, which I would avoid, and I'll explain that later. But let's go ahead and click on the magnifying glass here, and I'll go ahead and type in another address. Okay. So again, we're focusing on this dot here. The dot represents the subject property, but we also want to make sure we're paying attention to the property lines, right? Because if there were, say, a shade of red in this box, even though the rest of the square would be gray, because my property is basically showing up in red, right, within the property line, that would be an issue. But of course, it's not an issue right now, right? We can see this is all gray, so we're good to go here. But I just want everybody to be mindful of those property lines too. That's kind of a nuance that can catch people up sometimes. So make sure you're paying close attention when you're pulling up these properties on the map. You don't want to break any hearts, right? When your borrower's in contract and you thought it was good, but there's like a sliver of red or a sliver of orange or a sliver of pink on the property line, it totally kills the whole thing. So don't want to be there. Okay, so make sure you're dialed in on that. So as I mentioned, even though moderate is okay, right? Yellow is okay. What's required here is a traditional homeowner's insurance policy. It cannot be insured by a California Fair Plan or have a California Fair Plan companion policy, right? So sometimes with moderate areas, they don't qualify for a traditional policy because of the perceived risk by the insurer. They're going to classify it as a higher risk, and then you have to get California Fair Plan. And then again, you break a heart there because California Fair Plan is not acceptable under this program, right? So you want to make sure that policy is traditional. Another condition of eligibility on the property is that it meets the minimum and maximum number of bedrooms dependent on the household size. And this is going to be based on the federal standard of 1.5 people per bedroom, right? So again, if one person is occupying the home, the number of bedrooms they can have at minimum is one and the maximum is two. If it's a four-person household, minimum number of bedrooms is three, maximum is four, and so forth. And this chart is also on our website, as well as some of the forms you'll be filling out for the program. So you just want to keep that in mind as your borrower is shopping for a home. Make sure they have a competent realtor on their team that is also akin to all of these various requirements. Okay. So calculating the assistance, and believe it or not, this is a lot easier than some of you might think. Okay. It's really straightforward. You're going to take the purchase price or appraised value, whichever is less, and you're going to subtract the first mortgage loan amount that you qualified your borrower for, right? And then you're going to add their estimated cash to close and prepaids. And from there, you'll subtract any liquid assets they have over 100K or their duplication of benefits, whichever is greater. And then you're going to land on how much they're going to get. Okay. Now, some of you might be scratching your head right now and like, okay, well, what's a duplication of benefits? And what do you mean liquid assets over 100K? Let's get into it. So first of all, a duplication of benefit is essentially the assistance the borrower received for the same purpose as this program, right? Housing assistance as a result of a disaster. If they have money left over from that assistance, that's going to be considered a duplication of benefits. Liquid assets. Liquid assets include your checking, savings, stocks, bonds, mutual funds, right? It does not include your 401k, your IRA, your annuities, your life insurance, none of that, right? So if your borrower has over 100K in their liquid account, the portion over 100K would be the portion they would need to contribute to the transaction, but only if that amount does not exceed the duplication of benefits they have left over. And again, duplication of benefits is assistance they received before for housing purposes, disaster related, and they have that money left over. If they don't have any money left over, there's no duplication of benefits there, right? That money has been used up, it's gone, and it doesn't matter anymore, right? In terms of having to contribute it to the transaction. So what we have here is a chart that kind of describes what we are dealing with. It's giving a couple of examples here. All three of these scenarios are purchasing a $600,000 home, okay? And they each qualify for a different first mortgage loan amount, right? So scenario one qualifies for a $400,000 first, scenario two qualifies for $250,000, and scenario three qualifies for $150,000. And again, this is the first mortgage loan amount. So what's the required down payment? It's going to be different for each of them, right? So scenario one is $200,000, scenario two, $350,000, and scenario four is $450,000. So estimated closing costs, $15,000 for scenario one, $15,000 for two, and $9,000 for three. So here's the total cash to close. We're simply adding the down payment to the closing cost. They need $215,000 to close. Scenario two needs $365,000. Scenario three needs $459,000. Duplication of benefits. We're also going to use this interchangeably with liquid assets over 100K, right? So scenario one didn't have a duplication of benefits, nor did they have liquid assets over 100K. So theirs is going to be zero. Let's say this person had 135,000 in their checking account, right? Scenario two. So they're going to have to contribute 35,000 to the transaction. And then scenario three has $40,000 left over from the assistance they got from FEMA. So they need to put that $40,000 in the pot towards the transaction. So the amount of assistance required is then going to be reduced by the amount of money the borrower needs to bring in. Now, since scenario one didn't need to bring in anything, they're at 215, right? So they need 215,000. Scenario two now needs 330,000, and scenario three needs 419,000. And notice I'm putting the emphasis on need, right? Because that's what we're basing this on. How much do they need based on these numbers and these scenarios? Okay, so the max assistance allowed is going to be based on what they need up to the maximum available from the program. So scenario one, they only need 215,000. The assistance goes up to 350. So they're going to get the full, the max amount they can get is the 215, right? Because that's what they need. Scenario two needs 330,000. So the maximum assistance available to them is 330,000. Scenario three, their max assistance is going to be 350. Why? Because their need exceeds the maximum for the program. So they're going to be capped out at 350, and they need to figure out where the rest of the money is going to come from, right? The 109,000 left over after we put in the 350 in there, 40,000 from up here. Scenario two, they're going to have to bring in that 35,000, right? But they're still going to get the full 330 that they're eligible for. But again, they had 135,000 in their checking, so they need to bring in 35,000 to the transaction. And then scenario one, they don't have a required contribution because they didn't have over 100K in their checking, nor did they have a duplication of benefits. So the total amount of their assistance is going to be 215, 330 for scenario two and 350 for scenario three. Okay. So I know I just said a lot of words and there's a lot of figures on the page, but if anyone has any questions on this, please feel free to type those into our Q&A box. So the interest rate and lock process happens on our reservation portal. We provide an interest rate for the first mortgage that you will lock on our reservation portal, and then you will then lock it on your origination system. And the interest rates are arranged according to loan type. So Freddie Mac has its own interest rate on conventional, and then government has its own interest rate for FHA, VA, and USDA. You will be able to lock your first mortgage loan on our reservation system after you receive approval from our team. Okay, and that happens after phase two is completed. We send you a commitment letter for phase two. You proceed to phase three. That's your cue to lock in your loan as well as your assistance. Okay, so up until phase three, your assistance for the borrower is essentially tentatively reserved, right? It's like a maybe on an RSVP versus a yes. But once you get to phase three, it's a yes because you're actually locking it in. Now, of course, everything's still conditionally approved, right? We know deals fall out all the time, unfortunately. Of course, we don't want to see that on the program or ever really, right? We want all of our deals to work. But that's not always the reality. So I want to make sure everybody understands that just because you were locking it in phase three doesn't mean something can't happen to where the borrower is disqualified. Same way it would be on your end, right? You're at the funding table and the seller decides to bulldoze the second bedroom and now you can't close the deal, it died, right? Same concept with this program. Okay. So again, you will lock in phase three, and the lock period has a 60-day term. That's the period that you have to get the loan sold to US Bank, which is the servicer for this program. So really quickly, we're going to take a look at the online reservation system. I know a lot of you guys are probably already familiar with this, okay? But this is our reservation portal. This is the home page where you'll be logging in to register your borrower and upload documents and all that good stuff, right? But when you get to phase three and you're ready to lock, you're going to come under here where it says Message Center and today's rates to view the rates for that day. So you'll see three options: Platinum, Golden Opportunities, and Recover California. You want to click on Recover California. And when you do, the rates for the day will open up. It's time stamped here at the bottom right. Ginnie Mae, that represents our FHA, VA, and USDA loans, has a rate of 6% today. FHLMC is the abbreviation for Freddie Mac, and that has a rate of 6.75 today. And these rates obviously fluctuate with the market, but they're usually at or below market. Some people draw a blank when they get here. They see FH and think it's FHA, or they say G and it just throws them for a loop. I like to give people a cheat code that says G is for government, F is for Freddie. Okay, so if you get here and you start drawing a blank, remember G is for government, F is for Freddie. We all know Freddie is conventional, so I hope that helps. Okay. So again, you're locking in your first mortgage rate with us as well as the assistance at the same time. It's simultaneously locked with US Bank, but you will need to go in your origination system and lock it on your end. Specific to Freddie Mac, you want to make sure you have an approved accept from LPA. Okay. Um, it has to be ran through LPA on the conventional product because conventional product is through Freddie Mac and LPA is also a Freddie Mac product. You can still use DU on your FHA and VA loans, just not conventional. And again, you want to make sure you're running it through HFA Advantage and that you get an accept binding from LPA. If you're manually underwriting your conventional loan, make sure the loan to value does not exceed 95%. And then you also want to refer to your LPA findings to see if your borrower is eligible for charter level coverage on MI. It's very uncommon for MI to be a factor on this program because the assistance is so sizable. It's rarely resulted in an LTV that's over 80%. But in the event that that happens, check your feedback to see if your borrower is eligible for charter level coverage, which would reduce their monthly MI premium. When it comes to origination guidelines, you can charge an origination fee of 3% on the first mortgage loan or 2% on the first mortgage loan and 1% on the second. And it's not uncommon for the second to be higher than the first mortgage loan. So that's why we implemented this policy to make sure it's more fair. So you guys are being compensated for all the work and effort you're putting into these transactions. Keep in mind, no other fees can be charged on the second. Also, no discount points are allowed. You can still charge your ordinary and customary fees, right? Your processing, underwriting, funding, all your fees, all your lender fees. You just want to make sure they are within tolerance of the loan type that you're using. So, as the first mortgage lender, you will be funding the first mortgage loan, okay? And then when you sell the loan to US Bank, they will reimburse you for what you funded and provide a service release premium of 50 basis points. One of the differences with this program is GSFA funds the second, right? That's unlike any of our other programs. For this program, we fund the second. It's a very heavy balance in most cases, and we don't expect our lender partners to carry that on their credit lines. One thing to note is that purchase contract extension fees will not be reimbursed. So keep that in mind. Also, you want to make sure, as I've said before, that you're disclosing all the POCs rather, on your first CD and final settlement statement. So let's get into the details of the process, right? Okay. So there are 5 phases in total. And this is where, again, it's going to go off into a different, pace in terms of what you're used to with our other programs. Okay. So the first phase is the pre-qualification phase, right? That's where we're getting all the preliminary calculations and qualifications, eligibility requirements sorted to determine the borrower's general and even income specific eligibility for the program. Phase 2 is where the borrower gets into contract and there's all the property related documents there. Okay. Phase 3 is again the phase where you're going to lock in the loan as well as the assistance. Phase 4 is where the loan funds, and there's also some auditing done in that phase as well. That's done by agents, by HCD. And then finally, phase 5 is when everything is wrapped up into a nice little bow and the entire transaction is closed out officially. This is a flow chart to give you a general idea of how this all goes, right, process-wise. So we're here. GSFA trains approved lenders, okay, and then approved GSFA lender works with potential borrower, right? So you're going to get with a client, make sure that they meet at least the minimum requirements for this program, and then you're going to submit your phase 1 application to us. Phase 1 does not have a stated turn time on review, okay? We review phase 1 on a first in, first out basis. Okay, and so we review your phase 1 application. If everything looks good, we issue you a commitment letter and you proceed to phase 2. If everything doesn't look good, right? There's something missing or needs a correction, etc. Then we kick back a list of conditions to you. You work on those conditions, you get them back to us, and the review time starts all over from scratch. Okay. And that process rinses and repeats until all the conditions have been satisfied for that given phase. And then we issue the commitment and you proceed on to the next phase. So phase 1 is actually the most intense phase of the whole process, really. Okay. And that's because we want to make sure this borrower is not, we want to do our best, right, to make sure the borrower is not going to get their heart broken in phase 2 while they're in contract. So we're doing a lot of the vetting on income and eligibility, etc. in phase 1. And again, your borrower must not be in contract on a property in phase 1, period. If that happens, they will be disqualified. So you're determining the borrower's eligibility. Did they have a previous residence or even a current residence in an eligible area in an eligible disaster year, right? Was it in a high or very high risk area for wildfire? Do they currently own a home? No, perfect. Do they meet income, FICO, and DTI requirements? Yes, excellent. From there, you're going to go ahead and log in your borrower's info, right? You're going to register their info in our reservation portal. And you're going to follow our DR HBA 001 checklist for phase 1 to determine what needs to be submitted. So for the DR 001 phase 1 checklist, these are the items that we're going to need. We're going to need a copy of their government issued ID, 2 forms of verification proving that they lived at that impacted or high risk address in one of the corresponding disaster years. Okay, and so that can look like a tax return from that year, a W-2, a utility bill, right? A vehicle registration, insurance policy, etc. Something that has their name, their address, and the year of the disaster on that form. Okay, and it can't be something that shows the current year. We want it to be isolated to the disaster year. That is an HCD requirement. We're also going to need their most recent pay stubs covering 1 month or the most recent consecutive 4 weeks. Okay, and we need that pay stub to have at least 3 months income on it, right? If it doesn't have 3 months of income on it, we will average the year to date with the prior year's W-2, which brings us to the next requirement. We do need the prior year W-2. We also need the most recent signed and dated 1040 federal tax return. Just a pro tip, there's never going to be a situation where you submit a tax return to us that shouldn't be signed, right? They all need to be signed. If you're sending a tax return, whether it's for the residence verification, which we call MID, or whether it's for income verification, has to be signed and dated by the borrower, okay? If your borrower is self-employed, we're going to need 2 years of 1040 and business tax returns. Obviously, the most recent, we're also going to need a year-to-date P&L signed and dated by the borrower. And again, that's for self-employed. We also want you to specify which county your borrower is going to purchase in, right? Because we are evaluating their income. We want to make sure they meet the income limit for the county they're purchasing the property in. So on the checklist, you're going to tell us what county they're purchasing in, what's the income limit for that county, and what did you come up with for their income, their household income, right? And again, which could be different than your qualifying income. What's their household size, right? So again, all of this is to make sure that they actually qualify for the area they want to purchase a home in. We're also going to need the 1003 addendum to loan application and the application and affidavit. Now, really quickly, I just want to give you a quick tutorial of the application and affidavit. That's also known as Form DR HBA 002. Now, this is a phase one form that a lot of people get hung up on. This is the form we see the most errors on because for some reason people think they can just wing this, right? They can fill out some of it, leave the rest blank, or kind of halfway do stuff. And there's just no halfway with this program. Everything has to be 100%. Okay. Starting with your reservation number, you need to make sure that's entered here at the top right. All of these fields need to be filled out, right? So your lender name, this is the company you work for. Title, this is your title or the title of the person filling out the form. Contact name, who filled out the form or who's the contact for this transaction. Their email address, company address, phone number, all the stuff, okay? Your applicant's information, their first name, last name, social, email, phone number. This also applies to a non-purchasing spouse. If you have a spouse who's not going on the loan, they're not going on title, we still want to see their information here because California is a community property state. Okay, so you want to make sure everybody who's considered an applicant or a spouse of an applicant has their information filled out here. Pay attention to the eligibility information section, impacted property in 2018. It tells you the disaster year in the corresponding county. So whatever address you enter here needs to be one of these counties in 2018. We're not doing 2020 right now, we're doing 2017, but 2017 has a separate form. And again, you want to make sure you are filling out the address according to it, lining up with the impacted property disaster year, as well as the county where that property was located. Full address, county. Number of people who will live in the home, estimated household income, right? So not necessarily your qualifying income, your household income. The name and ages of every person who will live in the home being purchased through this program, even the applicant, their age and the relationship to the applicant. So for example, if my applicant's name is first, I put their age, their relationship is self, right? Because they're the applicant. Their spouse is on the loan. We're going to say their name, age, relationship, spouse, wife, husband, however you want to word it. And then we need to indicate, are they executing the deed of trust? Yes for my applicant, no for anybody else, if that's applicable, right? Or yes for whoever is going to sign. Maybe the spouse is going to sign, but the 12-year-old kid, they're not going to sign. So we're going to put no for them, right? The total liquid assets, again, this is liquid. So you want to make sure your liquid assets match. Oh, just saw a typo there. Ignore that. But make sure your liquid assets match what's on the 1003. Okay. And it's only the liquid, right? Checking, savings, stocks, mutual funds, etc. Not your retirement. Retirement does not go in this field. The applicant's total income, a co-applicant or spouse's total income, because again, everybody's income counts if they live in the house and they're 18 or over. Maybe they have a 19-year-old son who's still living at home and working at Burger King. His income will go right here. And then you're going to add those up for the monthly income, put that total figure here, multiply it by 12, and give us the answer there, right? That's the product. Again, number of people who will live in the home, right? And then this question here, number 8, is basically saying, I'm not an HCD employee and I'm not a GSFA employee, and I don't know anybody who works for HCD or GSFA. You're going to mark true for that if that's the case. If they know somebody that works for GSFA or HCD, or they themselves do, you're going to mark false. But the answer more than likely will be true. Okay. This is the chart that gives you the household bedroom numbers or bedroom sizes based on the number of people who will live in the home. bedroom sizes, bedroom count, okay? And then they need to initial section 12, date, printed name of the applicant, signature of the applicant. If the spouse is going on title, they also need to sign this form. Okay, and any co-applicant needs to sign the form. A certification of lender. So you're going to date the form as a lender and fill all of this out. Believe it or not, we've got these completely blank before. You're going to fill everything out. And you want to make sure the date you date the form is on or after the date the applicant dates the form. This is the addendum to loan application. So this is about the duplication of benefits. Did they receive, again, you want to make sure that reservation number is there. Did they receive any assistance? Okay. Even if they didn't, this form needs to be filled out. So, for example, you're going to fill out table 1. Let's say they're applying for the 2018 year. You're going to check 2018. And then it's asking you what kind of assistance did they get? Was it insurance? Was it FEMA? Was it other? So you are going to indicate how much they got, how much, what it was for, was it used for that, how much do they have left, right? Basically answer all the questions. Now, if your borrower didn't get anything, you can put zeros in these first 3 fields and on table 2 in the respective field, question 1, and then leave the rest blank. Okay, but if they did get money from FEMA, right, you want to make sure that dollar amount is in there and all the subsequent questions after that are answered. Even if the money they got wasn't for housing, you want to make sure you disclose that. It could have been for a car that, got burned in the fire, right? You want to make sure you put auto here and, $5,000 or whatever the case, and make sure all the fields are completed. So phase 1, you are, again, logging into the reservation system. Your borrower is not in contract, and you're going to fill out the screen. Okay, you're basically registering your borrower for the program at this stage. Once you fill out this form here, you're going to press next. It's going to prompt you to upload the documents. So you're going to upload all of the documents on the ReCoverCA 001 checklist, right? You're going to upload them individually, labeled as they're described on the checklist. And you're also going to upload the checklist itself. Once you have everything uploaded, you're going to click submit. Once you click submit, it fires over to us for review. We complete our review. If everything looks good, we issue a commitment. If everything doesn't look good, right, we issue conditions and the process starts over until everything is satisfied. Once everything is satisfied, we issue the commitment and you're on to phase 2. Now, phase 2 has a 5 business day turn time from the time we receive the package. This is the phase where your borrower has to be in contract, right? Because all of the documents required in phase 2, the majority of them are property related. So this is the phase 2 checklist, also known as ReCoverCA HBA 004. You want to make sure you complete this checklist and upload everything that's on the checklist individually, labeled according to how it's described on the document. So everything we have, this is a list of all the things that are on the checklist. Everything highlighted in blue here are documents you're going to retrieve from our website or portal, okay? And so the completed checklist is required, right? You're also going to do an environmental review form, disclosures, and then the conflict of interest affidavit. That's a new one. And then the rest of these documents are documents you will already have in your file or that you'll need to obtain for your file. So obviously your 1003 purchase contract, BRBC for broker, buyer's broker compensation. By the way, that is not something that HBA will automatically reimburse. There is an exception required for that, and we discourage that because by this time your borrower's in contract. The exception is an HCD review, which adds an unknown amount of time to getting the transaction closed. So, general rule of thumb, best practice is to negotiate the seller paying that buyer's agent fee. We need the appraisal, the hazard insurance, flood cert, the NHD report, and the fraud report. Okay, so you're going to log back into the portal once you have everything. Okay, you're going to upload all the documents that are on that phase 2 checklist, okay, which may or may not align with the portal. You want to follow the checklist, not the system, when you're uploading documents. Okay, only follow the DR HBA 004 checklist for what's required. Never the checklist, or never the system, okay, because the system itemizes documents and that may not align with what's on the checklist. So you're going to upload all of those documents, including the checklist itself, and then you're going to click submit. It fires over to us for review, which again takes up to 5 business days. We will issue a commitment if everything looks good. We will issue conditions if it doesn't. And the 5 business day period restarts from the time we receive what we asked for. Okay, and again, that review period restarts every time we have to issue conditions. So you want to do your best to make sure you have a complete, clean package the first time, or that you're at least complying with the conditions 100% if we have to send them out to you. Phase 3, this is where things start getting a little more fun, right? This is a lighter phase. This is, again, the phase where you lock in the rate and officially reserve the assistance. This is also the phase where you want to make sure your client has started their home buyer education process. So as we can see, the phase 3 checklist is a lot shorter and sweeter than some of the prior phases, right? All you're going to need from us is the checklist on this one, okay? And then you're going to provide your AUS findings, your 1008, your initial disclosure for the first, your initial CD for the second, if you're charging that 1% fee. Make sure that DTI is somewhere between 42 and 45, and verify your HBA amount, and confirm that the home buyer has started their education process. So you're going to log into the portal, complete the fields, lock in your rate, F for Freddie, G for government, okay? And then this is very short and sweet. Upload the checklist and all the documents that are on it individually, right? Labeled according to how they're described on the checklist. Click submit, and it fires over to our phase 3 team for review. And there are different teams for each of the phases. So you might have a deal going in phase 3 or 4, and you're like, I need to get in touch with somebody. Not going to be the people that you talk to in phase 1 and 2. Okay, so just disclaimer. Let's see here. Phase 3 is going to have a 3 business day turn time on review. And again, same thing, right? If it's good to go, they issue the commitment. You're on to phase 4. If it's not, they issue conditions, and the review period restarts from the time we receive those conditions and so forth. Phase 4, okay, so phase 4 is the phase where the loan funds, right? You get to send your wire, we send our wire. However, there are things that need to happen before that, okay? First of all, we need a final compliance package from you. That's a phase 4 package. Secondly, HCD completes an audit, right? So that's an external audit, which means we have to allow up to 10 business days to review and fund. So whatever's going on with your agent, your clients, et cetera, and so forth, you want to make sure everyone's clear on the expectation of that 10 business day review period before we can fund. And that's assuming everything is correct and complete, right? Before, right, when you submit it to us, okay? So this is when we complete all of our final reviews. HCD does an audit, and then we send that wire out within 10 business days on the second. You get to fund your first. Now, the phase 4 checklist is here. You're going to provide the completed final compliance checklist to us, the reservation and confirmation letter, as well as the funding and commitment letter, the annual compliance notice, And then the rest of these documents here, particularly your CDs and note and deed of trust, these are all documents that are final versions, but have not been signed yet. So your closing docs and all that have to be submitted to us before the borrower signs. They have to have our approval before the borrower can sign. And that's across the board for every lender. Okay. So we need the first and second CD, final AUS findings, first and second note and deed of trust, final 1003, 1008, escrow and wire instructions, and then that homebuyer education completion certificate. The reservation confirmation and funding commitment letters are retrieved from our reservation portal. The reservation confirmation is basically a lot confirmation from us, and the funding and commitment letter details the amount of assistance the borrower is receiving from the program. We provide the second mortgage note and deed of trust. You will retrieve those from our reservation portal. As well, you will need to generate an LE and CD for the second if you are charging that 1% fee on the second. Otherwise, you will use our partial exemption disclosure in place of the CD on the second. Make sure the dates on your first and second mortgage loan docs match, right? So if your first mortgage loan docs are dated May 1st, your second mortgage loan docs need to have that same date. Okay, everything needs to be consistent. So phase 4, right? You're gonna log into the portal, upload everything that's on that checklist for phase 4, including the phase 4 checklist itself. And then you're gonna submit, it fires over to us for review. We review it, we send out conditions if needed, and then we send it to HCD for audit. After that audit is complete, up to 10 business days, we send the wire for the second to title. Phase 5, so this is where people get to breathe a little bit, okay? Phase 5 is the loan has funded, but there's still more work to be done, okay? That's the post-funding package. We need that package sent over to us within 3 business days of closing escrow on the loan. And the phase 5 checklist is going to tell you everything you need. It's all outlined here. These blue documents are documents you retrieve from us, from our website, etc. Obviously the checklist, lender's cert, borrower's closing cert. These are certifications that nothing has materially changed to impact the borrower's eligibility for the program. Okay. And then these are going to be your final versions of what you submitted in phase 4. Final versions meaning they've been signed, right? So in phase 4, we wanted the final versions unsigned. In phase 5, we want the final versions signed, okay? You're going to upload everything on that phase 5 checklist, including the checklist itself, and then click submit. It fires over to us for review. We review it, and everyone can move on with their life. Now, you still have to get the loan sold to U.S. banks. You want to make sure whatever documents you have in the file for your first mortgage loan are all the most recent, accurate versions of the documents so you don't have any issues getting your loan purchased. When U.S. Bank buys the loan, they are going to net a funding fee as well as a tax service fee and any extension fees as applicable. And these fees are paid to U.S. Bank as the servicer of the loan. They are not paid to GSFA. If you need an extension on your lock, and again, this applies to phase 3 and beyond, we can allow up to 2 15-day extensions for you at a cost of 25 basis points apiece. And one point I forgot to mention in terms of extensions is in phase 2, once you get your phase 2 approval for your borrower to get into contract, we need you to be in contract within 45 days of receiving that approval. And we'll usually follow up within 30 days of getting you the approval to find out the status. The reason is because the funding for this is time sensitive. It's not an open-ended ongoing thing that's just going to be available forever. The funds do expire. And so we want to make sure your borrower is in line and their process is moving in a timely manner so that they don't lose out on the funding. Okay. So again, you need your borrower in contract within 45 days of getting your phase 1 approval. Now back to this slide here, cancellations. If you cancel your reservation after You get into phase 3, there will be a $400 cancellation fee along with the 30-day wait to relock the borrower. So we've covered a lot of information. I know it's a lot going on, but I hope you guys are ready, willing, and able to put in the work because it's so worth it. I mean, this is one of the most rewarding programs I've ever worked on in my career, and I get the same feedback from lenders all the time. So let's go over the benefits of this program. The fact that it provides up to $350,000 per household to help low to moderate income homes purchase a house outside of wildfire or high risk area for wildfire severity zones. Okay. They had to have been impacted or lived in an impacted region, right? According to what those eligible areas are. And they don't have to have perfect credit. DTI can go up to 45%. Lots of variety when it comes to loan types and property types. And they can purchase anywhere in the state of California as long as it's not in a high risk area for wildfire. And as detailed and document heavy as this process is, we try to make it as simple for you as we can, and we are always available to support you. We also have customizable marketing literature and social media content available as well that can help you spread the word for the program. Really quickly want to share this example of a $600,000 purchase price, right? And a borrower who only qualifies for a $265,000 mortgage loan, right? Now, that's a big gap, but in comes the assistance from the program, $350,000. They now have the $335,000 down payment, and they have $15,000 that can be applied towards closing costs. So it's not uncommon for borrowers to come in with little to none of their own money using this program. So next steps, if your company's already participating in the program, you want to reach out to your corporate, find out who manages accounts on your end and can get you access to this program, right? If you already have a profile set up because you're using our other programs, ask them to add this program to your profile. If your company is not signed up for Recover California, but they are signed up for the Platinum program, they can head to our website in the lender participation guide, fill out the program lender agreement and lender profile for Recover California HBA. Make sure your team takes the training so everybody's on the same page about how all this works. You can minimize stress and inconvenience for yourselves and your internal and external partners, and most of all, your clients. Okay. And then from there, you can start using the program. If your company's not signed up for any of our programs yet, the first thing they'll need to do is get in touch with US Bank, sign up as a correspondent lender in their HFA division, fill out these forms. After that's approved, take the training, start using the program. US Bank is going to be helpful if you have questions on your first mortgage loan, right? Overlays, nuances, etc. But for the most part, you're going to be working with GSFA directly on any concerns or scenarios regarding your borrower's transaction. Our website is also available. Like I said, lots of helpful resources there. We've got the lender participation guide for the program. We've got our training calendar, as well as supplemental content we publish periodically to bring you up to speed on what's happening with our programs. As I mentioned, customizable marketing literature is available in multiple languages in flyer and brochure format. It's available as a downloadable PDF. You can even type your contact details into it. We do ask that if you're using our marketing materials, that you're already a participating lender and that you represent the program accurately. And if you're not already a participating lender, at least be able to refer to one. And that does it for our training today. I want to thank everybody for their time and interest. Now we are at time, but I am still going to take the time to answer questions. So if you have to run, I understand. You're welcome to reach out to me and my team for support afterwards. But if you have questions, go ahead and drop them in the box and I will get to them now. First question, what's the max years or cost of a home warranty that can be paid by HBA funds? There was some confusion on that with one of my Recover California files. That's closed. It's been a bit so curious if anything has changed. I'm not aware of any change or specificity around that. That would be something I would definitely have to research. To my knowledge, home warranties are not covered because they're not a typical ordinary customary closing cost, which is what the HBA assistance is designed to assist with, right? So home warranties are typically optional in most cases, which would make it an accessory expense that would usually defer or default to the borrower. Next question. What is the front end ratio to determine the first? We don't have a front end ratio requirement, okay? We only care about the back end ratio. The only time the front end ratio matters is if it's a HUD 184 loan where they have a max 31% front end ratio. Okay, but otherwise, you just want to focus on the back end ratio and make sure it's between 42 and 45%. Also, be mindful of your AUS feedback and making sure your ratios are compliant there as well. Next question, does the first have to come through US Bank? So you as the lender, whoever you work for, you will originate the first mortgage loan, right? But you're going to sell it to US Bank. So you are going to need to be a correspondent lender of US Bank in order to use this program, as well as the participating lender in the Recover California to have access to the program. So US Bank doesn't originate the first, you do, but you will sell it to them. Next question, a little confused. Can we charge the origination fee and our customary lender fees, costs such as underwriting fee and processing fee? Yes. Yes. I hope that resolves your confusion. Yes, you can. You just want to make sure that you're within tolerance, right? So for example, VA, they only allow what, 2% max or whatever that is, right? I'm a little out of the loop on that, but if the loan type that you're using has some restrictions around how much you can charge in fees, then you want to make sure you're compliant there. You want to make sure it's passing the QM points and fees test and so forth, right? So that's what we made. So you can, yes, you can charge your origination fee on the first and the second up to 1% on the second, and your ordinary fees you charge, processing, funding, underwriting, etc. Okay. On the first, though, right? Because the second, you can't charge any fees on the second, aside from the 1% origination. Next question, what are they auditing? Meaning, what can go wrong at this point? Oh boy. That they are auditing basically everything. They're basically auditing everything between phase one and phase two. They're auditing your income. They're making sure that you use the maximum income that you could for this client, right? And that's one thing I want to make sure everyone's clear on. You have a responsibility as a lender to qualify the borrower for the maximum first mortgage loan amount on this program. So if they have bonus and they have overtime and there's a history of receipt, 2 years, right, plus likely to continue, and you exclude it, that's something HCD is going to catch in phase four and say, nope, you got to go back and redo your income to make sure the borrower is qualified for the maximum first mortgage loan amount. So that's why in phase one, we're sticklers about making sure that maximum income is being utilized. We understand that there are going to be times where you can't use an income because there's a lack of history or there's a lack of continuance. It's still going to be considered as a household, right? But not necessarily on your 1003. So that's an example of something HCD is going to check for. They're also making sure that the original property that they lived in the disaster year was in fact in a high or very high risk area. There's forms and the environmental review, all of it, right? So too much to name here, but yes, they pretty much check everything that happens all the way up to phase four. They're also auditing your CD, right, to make sure the fees and whatnot that you're charging are all, legit, that we're not paying for a buyer's agent fee if there hasn't been an exception for that, that there's no cash back to the borrower that exceeds the tolerance, right? That the HBA funds aren't being used to pay off debts to qualify. So all kinds of stuff. Next question, is lender paid comp handled in a typical manner above and beyond the origination fee? No. All of the rates are par, right? So you get your origination fee and whatever fees you charge the borrower for your processing, underwriting, funding, et cetera, and then the service release premium. But you're using our rates, right, which don't have any comp built into them. So whatever comp you're getting is still going to be worked out between you and your company, based on whatever you charged for the transaction. Next question. We're approved for platinum. Where do we go on the website to apply for this one? Great question. So, let's see. I'm trying to get to a link to the website. But basically, what you're going to do is go to our website and click on business resources. I'd like to give you a tutorial here. Let me see if I can get there a different way. Okay, give me just a sec. So I'm just going to open up a browser here, GSFA home.org. And this is also good if you need to know where the lender participation guide is. So this is the home page of our website. You go to business resources, then under lender guides, scroll to Recover California HBA guide. Okay, once you land there, it's going to give you our program policies, which gives you the various term sheets, forms required for each allocation and each phase. But to sign up as a lender, you want to come to this lender participation tab, and it gives you the forms that you need, right? So the program lender agreement and the lender profile. Okay, it also gives you contacts for US Bank if you're not already signed up with them. But these are the forms that you need for GSFA. Next question, are loan officers and processors required to take this course? Absolutely, absolutely. Those are the folks that are at the front of the borrower interaction, right? So they're the ones that are collecting documentation, communicating with the client, communicating with agents. They 1000% need to take this training because this is going to explain how everything works, the process, the forms required, why things are required, etc. So you want to make sure everyone on your team, even your closers and funders, need to take this training. Question, do you calculate income using a projected forward style like Cal Home, or do you use Freddie guidelines? So it is similar to a projected forward style. We use USDA criteria to calculate household income or to discern what household income is or what it captures. And then there's a projected income similar to Cal Home. But it is unique to HCD and their policies and procedures for this program. So it's not necessarily going to be identical to Cal Home, but it's definitely not Freddie guidelines. Now, that doesn't mean you can't use Freddie guidelines for your first mortgage loan, but when it comes to the household income calculation, you just want to be mindful that there is a different methodology for that. My pleasure, James. Thanks so much for your time and interest today. Next question. Once we are an approved lender, are we able to use this program on our TPO side? We don't have this available through TPO just yet, but check in with us. That may change. I don't think it will, though, just because this program has already been in existence for about almost 2 years now, and I don't believe we have any TPO options available just yet, but great question. Next question. Sorry if I missed this earlier, but will you be sending out the PowerPoint? Yes, I will. The slides will be out to everyone who attended today and made it to the Q&A session. So we are fully out of time. If you have any questions that you didn't get a chance to ask during the training, you're welcome to reach out to me and my team for support. We'll be happy to assist. With that said, I want to thank you all again for your time and interest today. We look forward to working with you. Take care.